Buying every dip in a highly leveraged market is a fast track to zeroing out your portfolio. Right now, institutional traders are setting traps to capture retail liquidity. Welcome to Crypto Whale Radar, where we decode the exact data institutional market makers use to move prices. Over the last 48 hours, Bitcoin officially confirmed a critical short-term warning signal, aggressively wiping out the upside liquidity. Before this video ends, I will show you the specific liquidity heat map level where institutional order blocks are currently clustered for a potential reversal. Surviving the volatility over the next 7 days means muting the social media noise and strictly executing trades off the institutional zones we are about to break down. This chart shows the broader market context. Pre-market trading for the S&P 500 is showing a distinct cool-off, directly driven by an overextended, overbought reading on the 4-hour relative strength index. As traditional equities pull back to reset their oscillators, they exert a gravitational drag on risk-on assets across the board. Crypto is not immune to this pressure. This structural drag is currently being accelerated by geopolitical tensions threatening global trade routes, triggering a sudden, sharp spike in crude oil prices. The maritime standoff in the Middle East has escalated, with extensive military deployments moving into the Strait of Hormuz, alongside the active seizure of commercial shipping vessels. Despite this heavy military buildup, Iranian leadership has issued statements clarifying that military aggression alone will not resolve the ongoing maritime blockade. When macroeconomic uncertainty collides with surging energy costs, institutional capital mechanically de-risks. It drains from high beta assets, and Bitcoin is the first asset class to feel that liquidity exit. This split pane chart illustrates the technical breakdown on the 4-hour timeframe. The top price line makes a definitive higher peak, while the RSI indicator simultaneously drops to a lower peak. That is a confirmed bearish divergence. Zooming into the micro 15-minute timeframe, the price action forms 3 distinct peaks, carving out a textbook head and shoulders pattern. Drawing a vertical trend line from the head down to the horizontal neckline, then projecting that distance below, targets the $76,000 mark. This heat map tracks retail bets. A dense cluster of glowing liquidity, representing leveraged shorts, builds above the current price. Market makers seek out these pockets. We may see a sweep of the $78,650 area to absorb those shorts, before dropping toward the $76,000 zone. Retail traders consistently lose their capital in these zones because they attempt to short a bottom or long a top against these liquidity sweeps. If you intend to survive this current market cycle and protect your capital, subscribe to Crypto Whale Radar right now. We track the data so you don't trade blind. Attempting to capitalize on these aggressive split-second volatility sweeps requires an execution platform with zero latency. You need absolute reliability to avoid account-draining slippage. For all of my specific long and short setups, I exclusively use BingX to execute the trades. By registering through the link in the description, you secure direct platform deposit bonuses, personal trading bonuses, and gain exclusive communication access for ongoing mentorship and real-time alerts. Having precise institutional data means nothing if your exchange freezes or fails during the one critical window when you need to enter the market. This is a line graph tracking Bitcoin dominance, and we can clearly see the line steadily climbing directly into a heavy resistance box sitting between 60.5% and 61%. As long as this dominance metric maintains a structurally bullish posture, liquidity will flow toward Bitcoin. Consequently, major altcoins will disproportionately bleed out against their Bitcoin trading pairs during any market dip. Ethereum has technically failed to break and hold its $2,400 resistance level. That rejection leaves its immediate path open for a drop down to the $2,150 support zone. Solana faced a rejection at the $90.70 resistance. It is now testing a fragile $85 support, and a break there targets the $81.50 floor. XRP has similarly suffered a rejection from its $1.47 overhead resistance zone. Its last line of significant macro defense sits down at $1.30. Therefore, holding leveraged longs on altcoins while Bitcoin dominance is climbing is a high-risk strategy, as these assets suffer the most during market-wide de-risking. This chart displays crypto funding rates. Currently, these bars dip below the bright neon baseline, representing 0.01% neutral territory. The axiom of funding rates dictates this creates an artificial premium for shorts. The market is already heavily biased toward the downside. This widespread short bias suggests the macro bull trend remains intact. True cycle-ending tops require extreme, euphoric, and heavily leveraged long positioning, which the data shows we do not currently have. Examining historical behavior during traditional equity pullbacks, resilient hard assets frequently experience sharp, violent price corrections without signaling the end of their broader upward trajectory. The current drop to 76,000 aligns with these broader market pullbacks, resetting leveraged positions without breaking the underlying macro structure. Your golden rule for the remainder of the week is simple: do not front-run the bounce. Wait for the price to hit the $76,000 mid-channel support before deploying your long capital. As promised, the exact invalidation level to watch is the $78,650 volume node. That is the area where early shorts are most likely to be squeezed out. Knowing when to buy the dip is only half the equation. If you deploy your capital into the wrong altcoins, you will still underperform the market. To ensure you allocate your capital correctly, click on my previous video, the top 3 altcoins to accumulate during a Bitcoin flush, which is on your screen right now. In this specific market structure, remember, patience preserves your capital, while impatience directly funds the institutional market makers.